Introduction. This module will delve deep into the components, techniques, assumptions, and challenges in forecasting cash flows associated with capital investment projects. An accurate forecast of cash flows requires a comprehensive understanding of not just accounting practices, but also financial modeling, taxation, macroeconomic variables, operational projections, and risk assumptions. Types of cash flows in capital budgeting. Capital budgeting typically involves three major categories of cash flows. Ye cosa. 1. Initial investment outlay. This is the total cash outflow that occurs at the beginning of a project. It includes purchase price of assets, machinery, land, buildings, installation and transportation costs, initial working capital required legal, consulting and licensing fees, less salvage value from replaced assets, if any. Note, financing costs, like interest payments, are not included in this step. They are accounted for in the discount rate, WACC. 2. Operating cash flows, OCFs. These are the recurring cash flows generated by the project during its life. They are typically annual and stem from revenues generated from the project operating expenses, variable and fixed, taxes after accounting for depreciation. A commonly used formula is OCF, EBIT plus depreciation, taxes or OCF, net income, plus depreciation, plus non-cash charges. Operating cash flows are also adjusted for inflation and changes in working capital. 3. Terminal year cash flows. These are one-time cash flows received at the end of a project's life. They typically include salvage value of machinery, equipment, recovery of working capital, environmental cleanup costs, if applicable. Tax effects on asset disposal terminal flows are significant and must be carefully forecasted, especially in capital-intensive or regulated industries. Incremental cash flows versus total cash flows. Only incremental cash flows that arise because the project is undertaken are relevant. Additional sales revenue from the new project, cost savings from operational efficiencies, new labor or maintenance costs, tax benefits from depreciation, not relevant. Sunk costs, e.g., past R&D expenses. Allocated overhead, not affected by the project. Financing costs, e.g., interest payments. Cannibalized sales, unless strategic. Adjustments for working capital. Projects often require an initial investment in working capital, inventory, receivables, etc. This is a cash outflow at the start, but usually recovered at the end of the project. For example, year 0, increase in working capital, cash outflow. Final year, recovery of working capital, cash inflow. If not properly accounted for, working capital can understate or overstate cash flow estimates, leading to misleading investment decisions. Tax considerations in cash flow estimation. Taxes significantly impact net cash flows. Analysts must consider depreciation's tax shield, non-cash expense reduces taxable income, capital gains or losses from asset disposal, investment tax credits, changes in tax regulations over time, tax loss carry-forwards. Tip: always compute taxes on pre-tax earnings, then deduct taxes to arrive at post-tax cash flows. Depreciation and the depreciation tax shield. Depreciation is a non-cash expense but provides tax benefits by reducing taxable income. Depreciation tax shield equals depreciation x tax rate. Common depreciation methods: straight-line declining balance, MACRS, Modified Accelerated Cost Recovery System in the US. Choice of depreciation method affects the timing of cash flows and the project's NPV. Inflation and cash flow estimation. Cash flows must be expressed in nominal terms, including inflation, if the discount rate is nominal. Alternatively, use real cash flows with a real discount rate. Mismatch between cash flow type and discount rate leads to incorrect NPV calculations, inflation impacts, future cost of inputs, labor contracts, maintenance expenses, sales prices, cannibalization and externalities. If a new project reduces the cash flows of existing operations, these reductions, called cannibalization, must be subtracted from the forecasted benefits of the new project. Conversely, positive externalities, e.g., brand recognition increase, customer loyalty may also arise but are often harder to quantify. Common mistakes in cash flow estimation, including sunk costs, ignoring opportunity costs, inconsistent use of nominal versus real values, excluding working capital requirements, overestimating terminal value, not accounting for project delays or cost overruns, using accounting profits instead of cash flows. Summary of cash flow components. Category, description and cash flow timing. 1. Initial outlay asset purchase, installation, WC year 0, 2. Operating cash flows revenues, expenses, taxes. Plus depreciation years 1N, 3. Terminal cash flow salvage plus WC recovery, exit costs final year.